Today, we're going to learn about an important accounting concept, interest on capital. Let's break it down step by step and see how it affects financial statements. Example: Transaction. Imagine a business credits 5,000 rupees as interest on the owner's capital. What does this mean? Let's find out. 1. Journal entry. First, we record this transaction in the books. Here's how the journal entry looks. On 31st March 2024, we debit interest on capital account with 5,000 rupees. And we credit capital account with the same 5,000 rupees. The narration reads, being interest on capital credited. Simple, right? 2. Rule behind the entry. Golden rules of accounting. Now, why do we debit and credit these accounts? Let's recall the golden rules. Interest on capital is an expense, and the rule says debit all expenses and losses. Capital is a liability. The rule says credit what goes out or increases liability. So, we debit the expense and credit the liability. Makes sense? 3. Impact on accounts. Now, what happens because of this entry? Interest on capital increases, which means profit decreases by 5,000 rupees. Capital increases by 5,000 rupees, boosting the owner's equity. 4. Effect on final accounts. Let's see where this appears in the financial statements. Profit and loss account for the year ended 31st March 2024. Under expenses, we add interest on capital of 5,000 rupees, reducing the net profit. Moving to the balance sheet. Balance sheet, as on 31st March 2024. Under liabilities, the capital account now has an extra 5,000 rupees, thanks to the interest added. Observation. So, what's the big picture? Profit decreases by 5,000 rupees since it's an expense. Capital increases by 5,000 rupees because the owner earns interest. And remember, no cash is paid here. It's just a book adjustment. Let's summarize everything we've learned. 5. Summary of impact. Here's a quick recap. Interest on capital is an expense, reduces profit, P&L account. Capital increases, boosts owner's equity, balance sheet. Key takeaways. 1. Interest on capital is an expense. It lowers profit. 2. It rewards the owner by increasing their capital. 3. It's like compensation for investing money in the business. Closing. And that's how interest on capital works. I hope this was clear. If you have any questions, feel free to ask. Asterisk.